The $634 billion question. What really happened to your metals? Gold dropped 21% in days. Silver fell 41%. And if you're watching this, you probably felt that hit personally. Maybe you questioned everything you thought you knew about precious metals. But while everyone else is asking, why did it crash? I want to ask you a different question. What changed fundamentally? Welcome back. I'm Your Name, and on this channel we cut through the noise to find signal. If you're new here, subscribe now, because what I'm about to show you contradicts almost everything you've heard about last week's crash. Let's start with one number that nobody's talking about, $634 billion. The $634 billion nobody mentions. That's how much China has pulled out of U.S. Treasury bonds since 2013. They went from America's largest creditor at $1.17 trillion to just $682 billion today. They've dropped from first place to third, behind Japan and the UK. Now the mainstream narrative will tell you this is about yields, or geopolitics, or trade tensions. And sure, those factors play a role. But the question isn't why they sold. The question is, where did that money go? Follow the money. When you liquidate $634 billion, you don't park it under a mattress. You redeploy it. And the evidence suggests a significant portion went into gold. The People's Bank of China reported 14 consecutive months of gold purchases, not sporadic buying, not opportunistic trades, 14 straight months through $3,000 gold. Their official reserves increased from 2,100 tons to over 2,360 tons, worth approximately $319 billion at current prices. But here's what matters. China's gold holdings represent just 8.5% of their total foreign reserves. Compare that to Western central banks. The United States holds 66% in gold. Germany holds 68%. France holds 65%. Even Russia, which only started serious accumulation after 2014, sits at 30%. China is at 8.5%. If they simply wanted to match Russia's allocation, they'd need 5,000 to 7,000 additional tons. At today's prices, that's $700 billion to $1 trillion in future purchases that haven't happened yet. That's not a prediction, that's not speculation, that's just math based on their stated diversification goals and current reserve composition. The central bank pattern. But it's not just China. Before 2022, central banks globally bought 400 to 500 tons of gold annually. Since 2022, over 1,000 tons every single year for 4 straight years. That's double the historical average, sustained consistently. J.P. Morgan forecasts 755 tons of central bank buying in 2026. Goldman Sachs estimates 60 tons per month. Both projections are triple the pre-2022 baseline. So when someone tells you the gold bull market ended last Friday, ask them which central bank stopped buying. I'll wait. The silver equation. Now let's talk about silver, because this is where the supply-demand math gets really interesting. And frankly, where the opportunity might be even larger. The silver market has run consecutive supply deficits for 5 straight years, 2021, 2022, 2023, 2024, and 2025. The cumulative shortfall is approximately 820 million ounces. That silver didn't vanish. It got consumed. It's soldered into solar panels across Europe and Asia. It's embedded in EV components that can't function without it. It's in AI server chips processing the data behind every ChatGPT query you make. And unlike gold, that silver doesn't come back to market. Gold gets recycled. Jewelry gets melted down. Coins get resold. But silver in a solar panel installed on a roof in Germany? That's industrially consumed for the next 25 years. Meanwhile, mine production grows at roughly 1% annually because 70% of silver comes as a byproduct of copper, zinc, and lead mining. You can't just open a silver mine when prices spike. Discovery to production takes 10 to 15 years, minimum. So you have exponential demand growth from solar, EVs, and technology meeting glacial supply growth from mining. Those trend lines are diverging, not converging. Add to this China implemented export controls on silver effective January 1st, covering an estimated 60–70% of global supply through 44 approved companies. Whether this is about controlling supply or national security doesn't matter. The effect is the same. Tighter markets, the infrastructure play. But here's where this gets strategic, not just financial. China isn't just buying gold, they're building the infrastructure to challenge dollar dominance. China has built an alternative payment system called CIPS, the Cross-Border Interbank Payment System. It's their version of SWIFT. In 2021, CIPS processed about $13 trillion. By 2024, that number hit $24.5 trillion. It's connected 124 countries and 4,900 financial institutions. They've also launched mBridge, a digital yuan settlement platform that's processed $5.5 billion since 2022, with the yuan accounting for 95% of transaction volume. And here's what should get your attention. Saudi Arabia joined as a partner nation. Saudi Arabia, the country whose 1974 petrodollar agreement has been the foundation of dollar dominance for 50 years, is now participating in China's digital currency platform. Additionally, 1/3 of China's international trade is now settled in yuan, up from nearly zero a decade ago. What this actually means. I'm not here to tell you the dollar is dying. It's not. The dollar represents 56% of global reserves. It has the deepest bond markets, the strongest military backing, and the most developed financial infrastructure on Earth. But the monopoly is eroding. In 2000, the dollar was 72% of reserves. Today, it's 56%. That's 16 percentage points over 25 years. Not a collapse, erosion. Slow, steady, structural erosion. And in that erosion, hard assets matter more, not less. The crash context. So what about last Friday's crash? Here's my read. It was a liquidity event, not a fundamental event. When CME hiked margin requirements, leveraged positions got liquidated. The paper market is thin. When forced selling hits, prices gap violently, stop losses cascade, algorithms amplify moves. That's mechanical, not fundamental. But ask yourself, did solar demand for silver disappear last Friday? No. Did the 5-year deficit suddenly close? No. Did China reopen silver exports unrestricted? No. Did central banks announce they're stopping gold purchases? No. Not one fundamental driver changed. Only the price changed. These aren't small regional banks making speculative calls. These are 4 of the largest financial institutions on the planet, with research teams that cost more than most people's houses, all maintaining or raising bullish targets after the crash. Why? Because they're looking at the same data I am. They see the same central bank buying. They see the same supply deficits. They see the same infrastructure builds. The bottom line, look, I can't tell you what happens next week or next month. Nobody can. Markets can stay irrational longer than you can stay solvent. But I can tell you what the data shows. Central banks are buying at record levels. Supply deficits are real and sustained. China is building financial infrastructure that reduces dollar dependency while accumulating hard assets. Does that guarantee prices go up tomorrow? No. Does it suggest the structural case remains intact? I think it does. The crash hurt. I get it. But every bull market has violent shakeouts. The question is whether the fundamentals changed or just the price. If this analysis helped, hit subscribe. Next week, I'm breaking down the COMEX delivery data that nobody's talking about. Drop your thoughts in the comments. What's your read on where we go from here? I'll see you in the next one.